So if you've ever wanted to sell your Amazon business, or if you've ever wanted to start an Amazon business and then eventually sell it, this is a conversation you're going to want to watch. This is a long conversation that I have with them, almost an hour long. Let me know in the comments below if you like these long style type videos and conversations. And if you do, I'll do more of them. Hey, everybody. I am super excited to have two titans in the industry when it comes to Amazon private label and the acquisitions and merger space. I've got Scott Dietz here from Northbound. He does consulting, and I'll let him tell us a little bit more about what he does, but he helps businesses prepare to sell and maximize valuations. And then I've got Ken Kubik. I hope I pronounced that correctly. I don't know if I've ever
Kubek.
said your.
That's close. That was good.
Kubek?
Yeah. Kubek. Yeah.
Kubek. Yeah. Ken.
Yeah.
Ken is with Thrasio. He leads their acquisitions team. Actual title, Ken, I'm sorry.
VP acquisitions.
VP of acquisitions. And so Thrasio was the first profitable American company to $1 billion valuation in American history. To give you an idea of the how big they are. And I think you guys just crossed 1,000 US employees or domestic employees. Yep. Congratulations on that.
Yeah, thanks.
So I remember a little over 3 years ago being at conferences when the company was just starting, when Thrasio was just starting, and I was speaking at events, and I was just starting to teach at the time, but I've been selling for a little over 5 years, private label, 6 years total. And I remember coming off, you guys would have a small booth. There would be 3 of you there. And you were like, yeah, we want to buy Amazon businesses. And I was super fascinated by the business model. And then shortly after, I think Stephanie joined MDS, which I'm a co-founder of. And I did a training with some of your people. And I just saw the trajectory. And I was so impressed because you had taken a company. I guess the story is you had taken a company, proved the concept, and then were able to raise a ton of money based on that. Tell us about like how you guys got started and everything.
Yeah, I mean that was it. I mean, so co-founders Josh and Carlos, just serial entrepreneurs. Carlos, prior to founding Thrasio, was started a Facebook ad agency, and he basically, was seeing clients come in, and he was scaling their Shopify or D2C businesses via Facebook ads. And then they were increasingly asking him, hey, can you guys manage Amazon ads? And we're going like crazy on Amazon. We don't know what the hell we're doing. We need someone to help us. So that kind of sparked, hey, his initial thesis was we could buy some of these Shopify D2C brands, and why don't we let the economics accrue to us versus, growing them for other people and just taking a small fee for it. And so he partnered with Josh, who's also a serial entrepreneur, venture capital turned operator. And they were going to originally do D2C brands. And then they got connected with Casey Goss, the founder of Viral Launch, and they kind of learned a lot more about the Amazon ecosystem. And then they were like, oh man, this seems a lot easier. Like the traffic's there. You don't got to go out and acquire it. And let's start looking at maybe Amazon businesses and optimizing its uniform back end, et cetera, and all the learnings you can leverage across multiple brands. So that they did, they bootstrapped, made the first, I think, 2 acquisitions. First one was in July of, 3 years ago, July of 18. Went out and raised the first $7 million of debt. Started to build the team, of which I was a part of. So I joined in the fall of 18. And our original, even on the Amazon side, the original thesis was let's buy like players on the top of page 2, the bottom of page 1, and rank them. And we were like, oh shit, this is tough. Like let's just go out and buy the leaders already on the top, and take it from there. And so that was the founding. And to your point, I mean, I remember going to Prosper in March of 19, and we had a banner and just said, we buy Amazon businesses. And 75% of the conversations were around the logistics of how you actually do that. Can you do that? So it's much different than this past year.
Yeah, it's amazing. And so, Scott, you came into the industry. I think you've been doing e-commerce since before the internet. Is that right?
Well, it's been a long time. That dates me a bit. My Amazon, I've been involved in digital marketing, decades. I did my first strategic exit myself in 2001, so I guess that's 20 years now. And I had my mentor, and I classic case. I tried to do it myself. Didn't know what I was doing. Didn't get to the deal. Got the handshake, but not the deal done. Found my mentor, and we took the company back out in a more strategic way 18 months later, and it took it from a low seven figures to eight figures. So you literally 3x the value, because I just didn't know what I was. I knew how to run a company, but I didn't know anything about how to exit a company. And so when the check cleared, so to speak, I was like, wow, I've got to help other entrepreneurs. If they miss out on this last step, they're really leaving, half the money on the table or more. And more importantly, they're not finding the right partner or the right buyer for their business. They may be thinking, if you don't know what you're looking for, you don't know kind of how to evaluate it. So track that forward, took a few years off, spent time with the kids, and then got into Amazon 2013 specifically. Had been in other parts of the e-commerce world before, but joined ASM 3, and I thought I was just going to do it for a lifestyle, and I couldn't believe, frankly, how easy it was to make money back then. It was, run a bunch of Facebook traffic, run it to there, next thing you know, you're ranked number one, for Black Friday. And, but I got my start into the advisory side. Actually, I joke about it. Ezra Firestone is to blame, because I paid for a day of Facebook training up at his house about how to diversify to Shopify. And they said, at the end, I'd love to show you this little model that I've built that helps me understand the strategic valuation of businesses, and I'd like to show you what I think your business is worth, and kind of why it might be worth more, than you think. And so, went through it at the end of the day, and he said to me, he goes, I got bad news and good news. He goes, the bad news is that your products aren't really great for Shopify, and you really don't know a lot about running an e-commerce business. He said, but the good news is, he says, what you've shared me regarding strategic valuations of company is just absolutely mind-blowing. I've never seen anybody talk about it like this, and I know everybody in the industry, and I think you should drop your Amazon business tomorrow and help other sellers, because the multiples out there are 2x. And I said, 2x, what do you mean, 2 times revenue? He said, no, 2 times earnings. And I said, what are you talking about? And he said, yeah. He goes, that's kind of where the space is at, which tells you this is 2016, how far it's come. And so I immediately said, wow, let me work on the way to build valuation so that we can provide clarity between buyer and seller and get to a level of what's a fair return for both sides. And so from that next morning, I woke up and said, it's time for me to start building this model that had version 1 of it, that he thought was had some value to it, and expand it out to offer it to the broader marketplace.
Yeah, that's so it went from finding what you're great at and what you love doing, and then really educating quite a few companies. How many have you helped exit at this point now?
Oh, I'd say dozens and dozens. I'm not sure exact number. And then we do a large part of advisory work. So we're not just on the kind of the last part. We do a large part of advisory work. So probably in the hundreds when you think about people that go through our programs and kind of help on the preparation side of things. And it's all around a common theme, which is like anything in life. If you decide that you want to exit it at the end of the journey, you probably built the house in the wrong way, and so that gets really, really expensive. And in my neighborhood now, a lot of times they just become tear downs, and you have to rebuild it again. And we really focus on kind of how do you build it the right way. Help people understand really who I call it, your ultimate buyer is your ultimate customer. And just like you're building a listing and it has to be benefit oriented and it has to speak in the language of your customer on Amazon, that's the same thing for a buyer. You have to think about what that eventual transaction is going to look like and build your company in a different way. And between Ken and I, we've seen hundreds, thousands of businesses built the wrong way and the right way, and you get pretty easy at being able to say, hey, these are the ones that are sustainable and these are the ones that add real value into a portfolio like a company like Thrasio or other.
Yeah, that's a phenomenal way to put it, because I know that we had you do a 3-part series for the inner circle, and it was, obviously we can't cover everything about the tips, the tricks, and all that, because that was combined like 5-6 hours of content that you did for us, and it was extremely helpful. And it's basically saying that as you're starting to build your business and you're growing it, you go from that 0 to 1, you should already be thinking about your exit plan. What is your goal? And Ken, I imagine you get a lot of deal flow that comes across your desk, and you can immediately tell who was thinking strategically about exiting early versus those who they just decided to sell one day.
Yeah, definitely. Right. I mean, they have a P&L that they believe in. They know the numbers down cold, right? They know they can explain, walk you through month by month what happened. They have a log. Oh yeah, ran out of stock here. This is what it cost me, et cetera. Right? They can explain. They have the narrative of the business, which any business owner should always have on top of mind. If not documented. And then there's sellers that are just like, yeah, I don't know. Oh, I think I'm making $400,000-$500,000 a year. I really don't know. I just know that what the Amazon transaction reports and summaries tell me that I made in cash.
And they just dump all of their statements and all of their business reports on you and say, you figured out, give me
exactly.
Give me a number.
We could be unethical and say, oh, actually you made this. We often share them the model back and walk them through everything to get them comfortable. And we would never do that.
Yeah.
Ruin our reputation. But some people could easily do that. Right. Say, no, you made this and this is what we're going to pay you. And if you don't know your numbers, you can fall victim to that.
Yeah, that's the super important part about preparing and understanding what levers there are to maximize valuation. And it's really interesting because you guys buy bestsellers. You're typically playing in the $1 million plus profit a year space. There are a lot of buyers out there. It's grown. We're going to get to where it's at now with the space, but from a business management and scaling perspective, it's been a really interesting journey for my wife and I, who are walking that ourselves. So we started 2016 as well, and we're going to do close to 15 million between all of our accounts and brands this year. And it's been such a huge transition. I always say that you can go 0 to 1, which is like just a term for business, but 1 being like 1 to 3 million in revenue in Amazon by yourself. With 1, maybe a partner, maybe 1 VA, you can legitimately have a 7-figure top line business with no problem. Then when you want to go to 10 million, for between 1 to 3 million to 10 million, you need to add some strategic team members who are just basically specialists. People that are good at one particular task, but they still only do what you tell them to do, right? Mm-hmm. Now, when you want to go from 10 to 100 million, you need to build a real company. That's where you're going to need management and management practices and real delegation and real strategy and understanding how and getting a machine that works for you where you're not delegating everything. That's really hard. Most people don't have that capability. And we hired a CEO coach that we've spent close to $100,000 with in the last 9 months to teach us. And it's been really helpful. We've scaled from 3 to 28, almost 30 employees. And it's been a journey for us, but that also squeezes margin. So that growth phase and those extra SKUs, for example, like we're going to go from 120 to 200 SKUs as well, like in the next 5 months. That growth phase is expensive. Product development, new product launches, all of that. How does that play in? I want to ask both of you, like, how do you factor in like growth and adding growth back into the valuation?
Sure. I'll go ahead, Scott. Okay, I'll take a crack at that. So I think here's the fundamental thing that I think we've in our efforts to simplify things in the industry, we've oversimplified. There's this concept that I build up a company, it's making $2 million of profit a year. There's this trailing thing called a multiple. Pick whatever number. It used to be 2, and maybe north of that. When I started, it's 3, it's 4, whatever it is, 5, 6, 7, 8. It doesn't matter. People tended to think that you take that number, it's 100% cash at close, and then you're done. And the reality with what sophisticated transactions are, when you get into that more sophisticated end of it, is it's both the multiple and the payment is based on a continuity, not a one-time event. And so the ability for you to continue to have growth in the tank of new products ready to line up here alongside cash cows, have the systems in place so that a buyer can ingest that and continue that growth trajectory. It's either going to show up in a roll to equity, it's going to show up in a stabilization payment, it's going to show up in an earnout, and you're really in partnership with your acquisition partner as to not what is this done in the rearview mirror. As I always like to say, no buyer buys or values it based on historical earnings, because the amount of dollars they get to keep of that is zero. You already spent that money in Vegas last month or wherever it happens to be. So they use that as a calculation tool. But I think the key for most sellers to get the understanding of is that a lot of times you get this thought process of slow down on the growth, maximize the profits because I got to maximize the multiple. And most of the time that fails because the multiple drops, because the growth drops, but you're really missing out on that partnership event trajectory. So we spend a lot of time in our forecasting tools helping sellers understand the dynamic of that growth curve. Like you said, what's the investment it's going to require? What's the working capital it's going to require? And then when you design a transaction there, that growth part of it is such an absolutely critical part of the story for someone like Ken and his team to kind of get their brain around, okay, how do we take that in and how do we accelerate that growth? And as we all know, it's a lot harder to get something moving than to keep something moving. So, my recommendation for sellers is just to recognize that your exit is not an event. It is a series of payments over time that is best maximized by, we've kind of coined the phrase, your lifetime effective multiple, which is your lifetime that you ever get from this divided by your trailing earnings rather than what it was just at the event. Because when you put all of these different components together, you have to look at that to properly evaluate both when it's the right time to sale and what's a realistic economics that you're going to get from a sale. And you have to look at two buyers. One of them has a 5 multiple and one of them has a 4 multiple on the entrance. That doesn't mean that's where they're going to end up. That's like, what's the score at the end of the first quarter? And as everybody knows, that doesn't win you a lot of games.
That's a phenomenal way to put it, is that when you're doing these projections. So first of all, these one-time events are usually getting added back because these are any one-time event or expense is generally like put back as towards that profit, because it's not going to happen again, ideally. And then you have your projections out for growth. Now, whether Ken and his team believe those projections is another story, because you are good at analyzing, like, okay, I, as a seller, can tell you a story. I've got 5 SKUs landing. I've got one I just launched. Here's what I'm projecting them to make. And then your team is going to look at them and say, that's way too optimistic.
Yeah, I mean, I guess it's more about having a roadmap and that business continuity, right? I mean, to Scott's point, his team does an excellent job of building forecasts on an ASIN level, and it leads to very fruitful conversations when you're negotiating around a business, and anchoring. All right, if you want to stay involved as a consultant and help launch these products, and if you hit these targets, we'll give you an extra bonus. Like there's a lot of creative ways you can structure deals when you get that granular around forecasts and belief in the growth of the business. Conversely, there's businesses we look at that haven't launched a product in 6 or 8 months, right? And they're coming off a COVID bump, and you're like, yeah, I don't know what, and they're already ranking 1 or 2 organically on all their top keywords, and they're spending 15% of revenue on advertising. We might be like, yeah, well, it's going to grow in line with Amazon. Like, what do we want to pay for that, right? Where we don't see a ton of upside. And that might be a deal where we get priced out of because it doesn't work our return hurdles, and we walk away from that deal, right? So I think it's important to have the business continuity, look at the launches, talk about investment phase and where the business life cycle is, because we see it. We go through it as an organization at Thrasio. Like, we're hiring tons of people, we're front loading expenses, for future growth and to build our infrastructure and platform out. So we're business minded people. We completely understand that, and we're not. We would rather pay up for something that we think has a lot longer legs of growth in the future than what they maximizing margins on a trailing 12 months basis, because those are the ticking time bombs, right? I mean, I would say Amazon is probably one of the most efficient consumer marketplaces in the world, right? Lowest cost provider is typically going to win. They're going to try and get there through nefarious tactics, and they might beat you with nefarious tactics.
That's such a like a thought shift. Like it is such a paradigm shift from what people were talking about 3 years ago. So we're going to go back to the timeline of the evolution of this industry that you guys have pioneered and has become such a titan it is. So you are telling me that 3 years ago the story was, don't launch any new products, don't incur any new expenses, sit on your books for at least 6 months and maximize profit before you sell, because everything is going to be based 100% on what that bottom line is in your business. And so this was what people were like actively telling other people to do, for before they sell the business. For Jennifer and I, we never thought that was a good idea. We were like, wow, that sounds terrible, because we know that if you get stagnant, you can die in this industry. Things change so quickly. And part of our success and our growth has been because we launched so many new products and because we're constantly experimenting and figuring out what's working and what's not working. So I love the fact that can be modeled in and taken into consideration, and then even add value versus hurting you because you had these extra expenses. And Scott does a phenomenal job of modeling that for you, and so your team doesn't have to do it, and telling that story, and then that story hopefully gets a much better multiple and much better well, not even just multiple, but just better bottom line offer, right?
Mm-hmm. Yeah. And I think there's the other part of that too, is, and I think what used to go on regarding, and it wasn't quote unquote gaming the system, but it was a lack of sophistication in the system, was the same thing that was the lack of sophistication that was going on in Amazon as a whole. You used to run a lot of tactics, 3-4 years ago operationally that you just can't do now. It's a new world about differentiation and brand and, and audience and high quality products and services to create review moats and those types of things, and so I think the transactional world was kind of modeling what was going on. I can do some gray hat tactics over here, I can play some games on my acquisition over here, and I can find a buyer, and that was kind of the model. The other core thing I think is absolutely critical, and you've I'm sure seen it now, Brandon, in your business. Oftentimes why we do the forecasting isn't so that folks like Ken believe it or not believe it. It's also so that the seller believes it, and they can set the right expectation themselves on two levels. What am I going to be worth in a year or two? Is it better to wait or hold? But also, what's the cash that it's going to take to actually make that growth engine a reality? And without proper forecasting, there is no business planning. And it used to be, I could go to Uncle Bob and ask him for $50,000 to help me with my inventory payment. I got to find a different uncle or somebody else when it gets to some of the inventory ordering that you're doing when you're getting into this size. And if you've got that potential in the business, but not the lifestyle capital that you want to keep throwing it back at the level of, $500,000-$700,000, $1-2 million of working capital, which is not uncommon at all as you're in growth mode, that might be the right time to say, you know what, I'll take some of my chips down. I'll structure a deal appropriately with somebody that has the capital, because I'm at a fork in the road to where I literally have to think that way, or I'm going to go from that 100% growth down to 20% growth because I just can't. Doesn't matter how profitable I am. So I think part of that forecasting sometimes is lost on the seller benefit of doing it as much as it is for explaining it to a buyer. It's really them understanding where you're at in the trajectory of your company.
So I love that thought, right? Because I think that there's another aspect to what you're saying. First of all, a lot of people underestimate how much cash is required to do the business. And so you do need to have really great cash flow modeling and understand, because most people, one of the most devastating things that you can do is run out of stock on Amazon. And it happens all the time. People underestimate their ability to rank and sell. They blow their inventory out. They try to relaunch the product in 2 months and now it's dead, right? And it's very difficult to relaunch for many other reasons, which is another whole class about how Amazon's algorithm works and all that. But the other part of that, which you're not thinking about, is on that growth trajectory, is what I had mentioned before, which is a capabilities issue. Most people are not capable of managing a team that's required to get to that next level, hiring a talent, training them, setting the right objectives, and then getting everyone marching in the right direction is really hard. And so, yeah, it's one thing to go to 3, 4, 5 million, but to go to 15 is just that another whole level. And I think that cash has become a much easier thing to come by. I think you guys at Thrasio just acquired a lender.
Yeah, Yardline Capital.
Yardline Capital. And I know that there are at least a dozen new lenders in the space that are coming in just as fast as there are people trying to buy businesses. There are just as many companies coming in trying to lend money to people that are in the industry. So
Yeah.
it's really an interesting time. So I think capital is one thing and borrowing is one way to do it. Raising capital from an equity perspective. Maybe there are some aggregators out there that are giving deals where they're taking a minority share or letting the operator stay in place while they scale it by infusing capital and some of their economies of scale capabilities. But let's go to like where 2018. We're in 2018. I'm standing in a conference in New York, and I see your team there in New York offering to buy businesses. This is like October or September of 2018, and the multiple that you're paying at the time is higher than anyone else was offering, and I think it was like 2.4 to 2.8x. Is that?
Yeah,
that's about
that's
range?
about right. Yeah, like 2 to 3. Yeah, maybe like 2.5 on average.
Yeah, and so everyone was talking in MDS because we had larger businesses. I think between us, when at that time we had maybe 200 members, and it was about 1.5 to $2 billion in management between the 200 of us, right? So a lot of us were at different stages of our business, and we were talking about exiting, and it was just something that we were always talking about. So at some point, multiples go up, and it goes up based on total size of the business plus the intangibles, those other capabilities of like intellectual property. So there's other levers, and Scott is great at describing this as well. There are other levers to grow valuation. And so if you've built a moat around your industry, now you can double that multiple in a lot of ways. And so we were seeing up to maybe 5x was like, wow, you got 5x. Like, what did you do? And it's like, well, I have this patent and I've got this thing, and I'm doing 5 million in EBITDA. And so like that I could get 5. That same business today, what is a $5 million EBITDA with intellectual property, has multiple bestsellers and has intellectual property protection? What is the market price for that now?
It's probably like, I can walk through the valuation history, but it's probably around the same, like 5 to 6 upfront, like at close
with earnout on the back.
And then 1 to 2, 3 years of earnout or some retained equity piece on the back end, right? I think just to address the valuations of the 2.5 that we were paying, like it was in an efficient market, right?
Yeah.
Like we were first mover in an inefficient market, so we were able to benefit handsomely from that for a period of time. And we kind of knew that, right? Which is, we flew under the radar for a while as best we could, but we knew at some point multiples were going to go up, right?
And now you guys you've moved because you have to, right? Like the market has moved. You're super competitive and staying ahead and aggressive on a business that you like.
Yeah, we always knew, right? We always knew this was going to happen, that multiples were going to go up over time as more competition came in. I mean, frankly, I've been a little surprised at the speed of which competition has come in, and the return hurdles that some people are chasing. I don't think they're going to get to their next round of funding, candidly.
I think a lot are going to fail. I think that's a conversation for another time where we can talk about the reasons why.
We're already starting to see some come to us. And they have a portfolio of 3 or 4 businesses that we looked at and passed on for various reasons, black hat tactics, et cetera. And so look, that, SMB, and Scott could talk to this too, but general like small, medium business, kind of solo operator or small teams, typically trade hands at 5 to 8 times EBITDA. I mean, that's America, like, economics of small business transactions. So where they're at today is, it kind of feels, for a business that size, okay. There's a lot of businesses that are a lot smaller than that. I'd say the sub 1 million in EBITDA is where I think I'm seeing crazy bids and valuations. Like it's like chum in the water. If you have a business at that size, I mean, I'd go to market right now. Personally,
yeah, it's amazing that you say that, because I tell my students, like we talked about it. I've mentioned it a few times. I don't need to exhaust it, but like, it's really hard to grow, right? It's really hard to scale. To go from 0 to 1 is easy. Like I can teach you the fundamentals of picking good products, looking at keyword research, choosing good products, and then launching them at a high success rate. You can get 5 to 10 successful SKUs inside of a year, where you can drive it to a couple $1,000,000 and then sell it at 5-6x your EBITDA. That's insanity to me. Like, and the thing is, you can sell that and then repeat that process.
Just go do it again. Yeah.
And do it again within 12 months.
Yeah.
And then Jennifer and I are like wondering, like, what the hell are we doing? Like not sleeping, working like 80-hour weeks, like hiring and scaling and figuring out how to do this to take it to 25, 50 million.
Yeah. Yeah.
Maybe we should just start 10 more small ones, like.
Yeah. People are doing it. I mean, we've already purchased a few like second time around businesses from entrepreneurs that we told them the same thing at the time, and it's like, people are always like not competing. I'm like, look, you have a skill set. We're not going to preclude you from going out and, making a great living and doing this again. Right. You can't do it. Obviously the same products that you just sold to us and brands and compete directly, but start it, in a different category and when you're ready to exit, come talk to us again. It's awesome to see.
Yeah, and I think that the aligning thing when we talk with our clients, we spend a lot of time talking about what, and you've heard Ken mention it a couple times here, the return hurdle, right? And that means something within a buyer's world that I don't know that oftentimes an Amazon seller, unless they've come into contact with an advisory person like ourselves or somebody else in the industry, really, we spend a lot of time explaining that concept in a very even less sophisticated way, but just to get the point across, which is that we call it yield. There's this yield that you got to be thinking about. And if you are flat growth and a buyer pays a 5x multiple for you and it lasted for eternity, which it never would, that's a 20% yield. And that gets guys like Ken fired. Buying businesses, with that low yield, like because the reality is that things never stay the same. Every football team's either getting better or worse at any given time. And so when you think about what yield hurdles are, they have this implicit curve to them that as a seller, if you know that, it allows you to understand where are we within the zone or the range of logic, and where are we getting outside that. And sometimes we caution people that the zone of logic is not, in the rounds on the too low, but also there's a little bit of it might be out in the bounds on too high with somebody that's trying to buy their way into a market. And as long as you maybe are the one taking all the chips off the table, you may choose to do that. But closing risk goes way up, lack of ability to close because it was a great idea until the first thing in diligence comes up, lack anything that you've got on an earnout, if somebody's, promising, massive multiples to everybody, the earnouts are not promissory notes. Those are not guaranteed or secured obligations. So, capability to execute and invest in those platforms. So I think the notion I'd like to throw into this discussion is that there's this notion of yield that is so important for sellers to understand, and the best way to understand it is just ask guys like Ken, how do I think about the yield of the that you need to achieve, and how do I think about how much growth that you're putting into this assumption, and open up that dialogue so that it's not a black art, it is reality that's out there, that oftentimes if you're a seller and you don't know that, your offer will feel too low or too high and you don't know why, and that's what can kind of align everybody together.
Yeah. And I think that what you're saying is absolutely true. And most people, I think the aggregators overestimate, outside of Thrasio and a couple others, I think they overestimate their own capabilities. And they made promises to their backers because a lot of them were raising capital. I've seen people who had very little success in private label, but they were mostly doing wholesale. They had a multi-million-dollar business, and then they raised tens and tens of millions of dollars with the idea that they can build a real company. But they still hadn't taken it to that next level of building a company with hierarchy and objectives and business management training. And and really gone, from to 100. But they were still able to raise 70 million or 100 million or whatever it is, like some absurd amount of money from a lender who has expectations that were set up by these people running these companies, and they've overestimated their own capabilities of running the company, getting economies of scale, diversifying to other channels, whatever value add there is that they think that they can get.
Supply chain management,
which has gone nuts, and
getting
and
containers.
it's been nuts for you guys, Ken, and for other buyers, because you had that COVID bump in a lot of categories where all of a sudden many brands down the page became viable, but now they're dwindling to nothing again. And a lot of people bought those. A lot of people sold at the high point, and a lot of people got stuck holding the bag. Yeah, that's, you can speak more on all of that. I mean, I'm sure there were a lot of points.
No, that's, I mean, just to Scott's point, right? I mean, on the returns, and that's why people are like, well, why couldn't you pay 10? Why couldn't you pay 12? I mean, at some point, some of us, I'm sure, will be public companies, and you can see what multiple we're trading at, and people will say, well, if you're trading at X, you should. And it's just, once you start like looking at that and allocating capital that way, your returns go down. And like, I spent over a decade investing in public companies and as a stock investor, and over time a company's valuation will reflect its return on invested capital. So if you're overpaying for assets and you're not growing them, and your returns shrink and your valuation as an entity shrinks, right? So we need to make sure we're buying assets attractively, and the assets we're buying, we can grow. And so that is a function, right? So if we know, hey, this company, we can grow this 100% for the next 2 years, we might be willing to pay 8x upfront for that business, because we have confidence in the returns that we'll meet our return thresholds. But if the business is declining, there's no way in hell we're paying 5x for it, even if that's what the market is. And those are the ones where I'm just like, you take it, like, someone else, please. This is a ticking time bomb, or I don't know what your cost of capital is, and I know, I'm pretty confident we have the most attractive cost of capital in the market right now. So to Scott's point, right? If you let's just say you're paying 10% debt, right, as a aggregator, and you buy a business at 5x, so you got 20% yield, and it's flat in year one, you've captured 10%, economic value, right, for the business. Let alone,
you might as well just go invest in the stock market at that point.
Yeah, right. I mean, just buy, So there's that. This is where I think, like, I always say this idea is great on a spreadsheet. And then you got to deliver on it. And that's where I think we are in this market cycle. And it is unfortunate, to Scott's point too. I mean, we're already had, a couple conversations every week our team does with people that sign term sheets with an upstart aggregator. And they're like, yeah, they didn't have the funding, or they sign 5 term sheets and then they go out to get the capital. They don't even have the capital in hand when they sign the term sheet. Or if they sign a term sheet and the buyers go, what do we do next? And the sellers are like, I don't know, what the hell, you're the one buying my business, right? Like, I don't know what to do.
Yeah, I've seen that in the space too. And obviously as a community manager, and as someone that has I guess an influencer in the space, right? Like I have a lot of people's ears, not just my thousands of students, but like the outside of that reach with social media and everything. I get approached on a regular basis, and I'm like, who are you? What have you done in Amazon private label to show that if you buy someone's business? And I was approached by a company, and I was blown away by this. They were doing exactly what you're saying. They would go to businesses and give a letter of intent at an insane multiple, at like a 7-8x multiple. And their goal was to hit a certain dollar amount, 40, 50 million, and then take that portfolio of with LOIs, not even the full purchase, just LOIs, and then sell that at 20x is what they said they could deliver. They could raise money at. And so they were like, yeah, this is a great business model. You should refer people to me and I'll give you a really nice commission. And they're happy because they're getting an 8x. And then we make a lot of money because we're going to get 20x on the back end. And I said, this is when I knew it was a bubble. And this is when I knew there were going to be a lot that fail. It's unfortunate. But I've even heard stories where most people backload most of the deal at a very high promise, and then the stock tumbles, or they're unable to deliver because the capital runs out, or the bubble products fail, they ran out of stock, they weren't more efficient, inventory margin compressions happening all over in every industry right now because of shipping and everything. So they just weren't able to deliver the terms they were, and they ran out of capital and money, and now they go to you to try to sell their portfolio to you. And you don't necessarily want to bail them out, but if the price is right, you might.
Yeah, no, if the returns are there, we'll definitely look. I mean, like, it's inevitable. There's going to be a consolidation of the aggregators, and the ones that fail, and that they bought good businesses or they have good listings, and but when we look at that, right, we're like, all right, now we got to commit more working capital and resources to it, and we got to take that into account when we're pricing a deal that of that nature as well, right?
And so and Scott, your business model is, part of it is that you prepare people to you tell the story properly, you show the true value of the business based on projections, growth, and the right numbers, and you help put it into a nice package that helps Ken and people in Ken's position really look at a business and understand it better, quicker, and make a decision faster. And so, how many of these businesses have you seen that have come to you to look for deal flow that you wouldn't trust, or that you don't think are doing the right thing, or that you could tell right away they don't really know what they're doing?
Yeah, I think there's kind of two things to that. One of them is it's such a dynamic marketplace that I liken it. I'm a football fan. I liken it to a defensive back. You have to have a very short memory, because there are people that are on top of the world that fail, and there are also people that are struggling. They buy a couple great businesses, and then that launches them into a new round of capitalization. And so it's a very dynamic marketplace out there. I think the thing that I would advise sellers on is, first things first is you. And there are certain things that you will be valued at a premium capability. I call it sort of the big four. Your profitability percentage north of 20, which is not easy, but it is reality, is that, you have to have a profit percentage that, you get down below that, you start to lose premium valuation points. You got to have the growth rate. You got to have diversification in a lot of times, with the exception of sometimes, companies like Thrasio, that they can live, they have the diversification, but diversification has to be in the deal. If you don't have it and you go sell to the doctor who has never bought an Amazon business before, by definition, we always like to explain to our clients who should pay the most for this business. There's an answer to that question, and if your buyer is not 5, 10, 15 times your size, their risk profile is too high. They're by definition rarely going to be the highest bidder for your particular business. And then you have to look at, once you've got those metrics in place, then you have to look at things like brands, product, capabilities, differentiation, all of these different types of things. But I think the first thing a seller has to think about is, what will get me that premium valuation, and build toward that. And oftentimes that's not you can do it at the end. You have to kind of think about that strategically. And then the one other thing, we've talked a lot about multiples, and multiples are appreciating, particularly for we're in the premium business market. So, we represent generally the top 5% of sellers. So I don't have a lot of experience in sort of the average companies. We kind of do premium valuations for premium companies, because we know there's buyers out there that are willing to pay premium because of the characteristics of what they're getting. But I think the part that we maybe haven't talked about here today is the culture part of your acquisition is absolutely critical, not just the multiple. If we were to, think about how many webinars have been done in the last 5 years on multiples in this industry versus getting culture right, it's a pretty, astounding difference. And we I think about that a lot, and probably with a compliment to Ken and Carlos and Josh and those guys, what they got right on the culture, what most people aren't aware of, which was, when they started out, they didn't want the sellers to have 50 different cultures with 50 different ideas on how to build a team and a culture. They said, as we're making a market, we're going to pay a multiple, we'll keep you on for 60 to 90 days. We're going to go build our own culture first. Now they have an ability to take on Amazon entrepreneurs on a consulting arrangement or a long-term, because you're now adopting to a culture rather than having a culture be a random collection of what all the 50 entrepreneurs were. They really focus on the operational integration and processes side. And so I think for sellers that are looking for, if you are staying on, thinking about that culture, and even if you're not staying on, that culture is what drives your future payments, because it's a big aspect of what drives the success. And so, I think when I watched that from afar, I could clearly see that when you're making a market, it wasn't the right time to maybe bring in everybody that wants to stay on and have 50 different cultures. But then now, once you've built that, you've got that ability. And so for sellers, to really think about that culture aspect is, as much as the multiple aspect, I think is so critical. So so Ken, I guess that's what I've observed on the outside.
No, it's a great observation. I mean, we say internally, like, the culture of Thrasio is a reason for our success, no question. I mean, ask anybody that is an employee. It's an amazing culture that we're super proud of, and we live and die every day protecting that, because we know that's the future of success. And we've had, multiple deals we've looked at, like 100 million plus type acquisitions, both, kind of business as usual and strategic. And, Carlos is like, guys, he's like, too many people, like, culture doesn't feel right. This, like, we can't do it. This is, we have to keep our eyes on the prize and just keep doing what we do it well, and not, chase something, right? I mean, we're in a great position in terms of a company and access to capital and things of that nature, that we the hardest part now is staying focused, right? We could be,
it's easy to get shiny objects.
Well, let's go over there. Let's buy, a massive wholesale business. Let's go buy this, that, X, Y, and Z, and add a lot of undue complexity to the organization at this point in time. And there'll be time for that, and we're being strategic and thoughtful, and making sure we're ready to digest something like that, versus just, scattershot, right? You kind of need a strategy. And to Scott, your point, I mean, our strategy has been protect the culture. And we are at a point now where we are, look, we're not going to write a $7,500 million check for a business and be like, all right, you're gone in 60 days. Right. I mean, we want to make sure there's continuity and handoff. And, if there's key employees we need to bring in to Thrasio, we're doing that. I think it's fool's errand to think, as we get to make larger acquisitions, that people are going to ride off in 60 days. Right. Business as usual, Amazon. Sure. You got a portfolio of 50 ASINs is selling in the US and Amazon European marketplaces. Yeah, we can digest that easily. Right. Even in Europe, there's a lot of complications and, taking over accounts and VAT IDs and all this stuff. But, it's important. And I think one of the things, I think Scott and his team add a lot of value on is just that institutional knowledge of the buyers, right? Of who they've worked with, who's come into the market, who's real, who's not. That alone, right, could be worth, a couple $1 million on a number and an offer, and actually going through with a full transaction, right? Because you see it. I mean, I see businesses that sign with somebody, don't know who it is, and then they come back to us and we're like, all right, well, you didn't like our offer at first, but that offer still doesn't stand now. Like, you're in a weaker negotiating position, right? I mean, and maybe, that's just the way the world works. And, nobody wants to be the second date. But, it happens sometimes. And, we obviously don't take that hard of a line, but there's times where people have come back around and we're like, yeah, we've moved on. We're no longer interested.
Mm-hmm.
Yeah, I mean, everything changes, and obviously new data means new information, which means new offer.
Yeah, exactly.
Yeah, so I think this was fascinating. I know we ran over. I wanted to not necessarily go a full hour, and we pretty much hit it. But the market is phenomenal. I think that both of you have done an incredible job. First of all, educating and being involved in the community. Even from Thrasio's standpoint, you guys are throwing events and you're out there, and a lot of it is obviously brand recognition and being the first to come to mind when it's time to sell your business. But at the end of the day, you're also doing a lot of on the education component, and making sure that people understand what to look for. And Scott, you're an industry leader when it comes to that. Obviously, not every business is right for you, because you do have your niche that you prefer to deal with. Tell us a little bit about what types of businesses are a good fit for you, Scott, and how people can get a hold of you.
Yeah, sure. So, first of all, appreciate the comments. And I got into this for the passion that I mentioned at the beginning. So while not everybody might be a direct client, our mission is to help as many people have life-changing events as possible. We always say we work for owners, not businesses. So, at all sizes, all parts of the game, we're trying to put out content, and if you want like you said, the 6-hour version of how I think you can help maximize your value, talk to Brandon, and we put that program out there for exactly that reason. Our niche tends to be people that are more on the premium side of things. We generally work with businesses that have $1 million of EBITDA or more, and the best way that I would say is decide where are you in your journey that you want to bring in somebody that thinks differently than you. A lot of times people start too late in the journey. We always encourage you to have those initial discussions earlier. You can certainly reach out to Northbound at www.northboundgroup.com, or myself is Scott at northboundgroup.com, and we want to be a resource for all sellers, and we want to focus you on the things that will drive your valuation the highest. And our model is very simple. We think it's the better way to you to go through this process is for you to focus every minute you can on maximizing the value of the company and have as little distraction through the transaction process as possible. And we will connect you with the resources in our firm that help you stay focused on the business while we stay focused on helping you maximize that value. Might be 3 years. We just had a client that we exited, large exit, met them when the valuation was a couple $1 million, and we exited for more than 30-40 times that. So the length of engagement goes with when do you want to design your program, and that's the value I bring to the company, and that's the passion that we have on it. Is we don't pick when you should exit. We pick the strategy that helps give you the knowledge to then know your own exit. So that's our end of the game. And even if you're not a direct client, we have knowledge and content we want to give you to help you along this journey as a seller.
Thank you so much for everything you've contributed. A lot of times people can see the relationship between you and Ken as adversarial, because you represent the buyers and he represents the sellers, and he represents the buyers and is the buyer. But I think that it goes hand in hand, because Ken appreciates when he gets something that makes his job easier too. So
if you've seen Ken and I, that I would never engage in an adversarial physical confrontation with him.
Put some pads on us and let's see what happens.
Yeah. It's not. I mean, nothing's adversarial, right? I think we all
business.
We're all looking for a win-win, right? I mean, to Scott's point, right? Like I remind my team and in the company, right? It's like, it's easy for us to get lost in what we're building as Thrasio, but I'll also remind people, like, look, we made 130 plus like entrepreneurs' dreams come true of realizing like multi-million-dollar exits. Like, that's awesome, right? Like, as an entrepreneur, once you have that exit, that's your, that's the hill, right, that you've been climbing oftentimes. And to have a hand in that, and I mean, I think Amazon, that gets lost too on broader society. Like, Amazon is like probably one of the best models of entrepreneurship that's ever existed, right, in the United States. And it's awesome to be kind of on the in that ecosystem. And Brandon, you do it too. Like, you do great service, and to the system and the marketplace, and with your sellers and helping them grow and exit as well. So thank you as well. And we're all in this. It's a rising tide, right? I tell people, I mean, there's people like, hey, I got this offer. I'm like, hang up the phone or shut down the Zoom and go sign the term sheet if they're really offering you that, because that's awesome. Like, I'm like, we're not going to get there, So we're not sharks. We just want people to win, and there's enough businesses to buy that we're not going to buy them all. We can't buy them all. We don't have the capital. So yeah, it's never adversarial.
No, in your business model, I always love the approach that you took from the very beginning, and I'll wrap it up now. which was you didn't mind buying bestsellers, or and Scott touched on it earlier, which was you created your own portfolio and machine to create your own diversification.
Yep.
And Scott touched on how diversification needs to be somewhere, either in your own portfolio or in the buyer's portfolio.
Business. Yep.
And you guys did that by buying all bestsellers. And so if one fails, then it's your portfolio that's still okay because you've bought a lot of bestsellers. Yep. And that was your thesis, and you've executed phenomenal. And we always look at it too. It's like, well, do we want to have 800 SKUs that you have your $1 million of EBITDA spread among? And that's so hard to manage, right? Like you need a much bigger team to do that. And you need to focus on the 80-20 rule. And you often probably buy businesses and throw out profitable SKUs just because it doesn't make sense for you from a cost to manage those SKUs basis. So thank you for joining me, guys. I think that it's important that people understand where we're at in the industry, the growth, the trajectory. You were one of the first movers, or the first mover, and Scott's been in the industry since I had a 386. So Pentium 386 processor. And I think if anyone has any questions, please reach out. Ken, how do people get a hold of you, or who do they contact if they're looking to maybe sell their business?
Yeah, just go to our site. We just have a form fill there, or reach out to me, LinkedIn, or email ken@thrasio.com. We actually switched over to the .com. We were thras.io forever, and then it was like, thras.io or Thras. I'm like, it's Thrasio. So we put on our big boy pants and moved to the .com.
Yeah, congratulations on that acquisition. That's one of your most important acquisitions.
Yeah, exactly. Got to defend the brand.
Have a good one, guys. Thank you so much.
All right, thanks a lot. Take care, Ryan.